Welcome back to Skytech-Lens. In global economics, stability is everything. But today, the US-China trade relationship is held together by a fragile truce. One that could end with a single tweet. The current moratorium on new tariffs is a ceasefire that can be revoked with just 60 minutes notice, sending shockwaves through boardrooms and supply chains worldwide. The US president's power to impose tariffs instantly has become a sword of Damocles over the global economy. This isn't just theory. 63% of American manufacturing managers now rank political tweets as a top operational risk, on par with labor costs or raw materials. Unlike declared tariffs, the threat alone haunts every transaction, forcing companies to plan for contradictory scenarios and driving up risk premiums in financial markets. The US 10-year bond 5-year forward swap has ticked up by 11 basis points, reflecting market anxiety over unpredictable policy. The Stockholm extension of the tariff moratorium brought only fleeting relief, no binding commitments, just a diplomatic placeholder. Now America's complex supply chains are as volatile as trending topics on social media. This is a shaky foundation for prosperity, and the cracks are already showing. The new normal is uncertainty, and it's reshaping the way the world does business. For most Americans, trade policy feels distant, until it hits their wallets. Tariffs on imports don't disappear. They're passed down the supply chain and land on the price tag at your favorite store. Companies facing sudden cost hikes must either cut profits or raise prices. Most choose the latter. Inflation is no longer a threat, it's here. The University of Michigan's July survey shows inflation expectations at 3.1%, with most of the rise blamed on import costs. Consumers expect higher prices and retailers are quick to deliver. The Federal Reserve is stuck. It can't cut rates to boost the economy without stoking more inflation, raising the risk of stagflation. American families are squeezed, paying more for goods while the Fed's hands are tied. If tariffs resume, Tesla's Model 3 battery costs would jump $800, and Apple faces a 15% tariff on key components, forcing tough choices between higher prices or less innovation. In every case, unpredictability at the top means higher costs for everyone else. The American consumer always pays for trade policy built on uncertainty. The checkout line is where global politics gets personal. This economic standoff didn't happen overnight. It's the result of escalating moves since late 2024. The US hit Chinese industrial components and consumer electronics with steep tariffs just before the holidays, then expanded to food processing machinery in early 2025. A third wave targeting consumer goods was only paused by a fragile 90-day truce. China responded with targeted tariffs on US agriculture and regulatory roadblocks for American tech and aviation. Both sides are technically at peace but remain ready for immediate escalation. The truce is just a pause, not a resolution. The next move could trigger a full-blown trade war. The trade standoff is hitting home, from Iowa's fields to Midwest factories. U.S. soybean exports to China are down 14%, corn and sorghum by 11%, leaving farmers with unsold crops and mounting losses. Iowa alone faces a $2.7 billion farm income deficit. Manufacturing is also reeling. Tariffs on Chinese components have driven up costs and delayed deliveries, pushing the sector to the brink of contraction. Apple and Nike are scrambling to diversify but can't fully escape reliance on China for critical parts and materials. Logistics are slowing, electronics deliveries to US factories now take over 4 days longer, and customs delays are piling up. Nearly $2 billion in goods have been flagged for risky origin declarations, causing costly port delays. The result? Higher costs, slower production, and mounting anxiety across American industry. The pain is real, and it's spreading. America's biggest retailers are stockpiling goods like never before, abandoning just-in-time efficiency for survival. Walmart's inventory days have jumped from 73 to 81, Amazon's from 51 to 63, tying up $14.6 billion in extra stock. To finance this, retailers have taken on $8.3 billion in new debt, adding $210 million in annual interest costs. Legal and financial costs are rising too, with $480 million in new bank letters of credit. This inventory bloat is a hedge against unpredictable tariffs, a costly bet that things will get worse before they get better. When efficiency experts choose to clog their own systems, it's a sign of deep mistrust in policy stability. The Great Stockpile is more than goods, it's a monument to economic anxiety. Retailers are paying a premium to shield themselves from political risk. The cost of uncertainty is now measured in warehouse square footage. The biggest long-term casualty of trade uncertainty? Investment. U.S. fixed capital investment growth has collapsed from 7.2% to just 0.3% in under a year. CEOs are openly deferring projects. CapEx deferral mentions have more than doubled in S&P 500 earnings calls. The reshoring initiative reports a dramatic slowdown. Only 86 projects moved from China to the U.S. in 2025, down from 319 the year before. 74,000 manufacturing jobs are at risk, and over half of CEOs are postponing investments. Instead, companies are shifting to Mexico and India, fueling record imports and production there. Wall Street is already pricing in the pain. S&P industrial sector earnings forecasts have been slashed, and tech profit estimates are down by billions. The investment engine is sputtering, starved by policy fog. Without clarity, growth and jobs are on hold. America's economic future is stuck in limbo. The US and China are fighting this trade war on very different terms. America's public brinkmanship relies on tariff threats, but the unpredictability is hurting its own economy, stalling investment and fueling stockpiling. China, meanwhile, is cushioning its economy with domestic stimulus and strategic discounts for its own market. The yuan's depreciation and new trade ties with countries like Brazil are blunting the impact of US tariffs. China's losses are projected at just $34 billion, largely offset by internal measures. The US faces much deeper wounds from its own uncertainty. It's a clash between tactical pressure and strategic absorption. The scoreboard so far: China is weathering the storm better. The true cost of this trade standoff is staggering. $225 billion in lost US economic output, according to the Congressional Budget Office. This isn't just about tariffs, but the price of instability, investments not made, jobs not created, and innovations left on the shelf. China's projected loss is a fraction of that, highlighting the asymmetry of the damage. A single impulsive tweet could turn these forecasts into immediate chaos: violated contracts, shipping turmoil, and market panic. The economy is being held hostage by policy that can change in an instant. When rules are unpredictable, everyone pays the price. The question now: how do we navigate a future where so much depends on a single moment of uncertainty? Thanks for watching a video, and subscribe the channel Skytech-Lens for more updates. Thanks.